Most people are misreading XRP right now. While the market is focused on the Clarity Act and XRP's recent price momentum, a much larger force is developing in the background: Federal Reserve policy and the return of inflation pressure. In the next few minutes, we'll analyze why liquidity, interest rates, regulation, and institutional adoption could determine XRP's next major move, and why the market may be watching the wrong catalyst. XRP is moving higher, but the biggest factor driving the next phase may not be headline everyone is watching. Right now, traders are focused on one major event: the potential passage of the Clarity Act and what clear regulation could mean for digital assets. But markets are not controlled by headlines alone. They are controlled by capital flows. And one of the most important shifts happening right now is the changing outlook around Federal Reserve policy. The probability of additional rate increases has moved higher as inflation remains elevated, with energy prices adding pressure through ongoing geopolitical tensions. And this matters because crypto does not operate in a vacuum, ladies and gentlemen. When liquidity expands, risk assets often benefit. When liquidity tightens, speculative assets face a much more difficult environment. The question investors need to ask is not simply, can XRP benefit from regulatory clarity? The bigger question is, what happens to XRP if regulatory optimism meets a tightening liquidity cycle? Because short-term price movements are driven by narratives, but long-term market cycles are driven by liquidity, adoption, and institutional demand. And understanding the difference may be the key to understanding what happens next. XRP recently pushed higher, gaining approximately 3.5% and reaching around the $1.15 level as traders reacted to renewed optimism surrounding the Clarity Act. The market narrative was simple. If the United States finally provides regulatory clarity, institutional adoption could accelerate. And that argument is not without merit. Clearer rules can remove uncertainty. Institutions generally do not allocate billions of dollars into an asset class when they do not know how regulators will treat it. That is why regulatory clarity has become such a major theme across digital assets. However, investors need to separate two different forces. The first force is speculation. The second force is structural adoption. Short-term rallies can be fueled by expectations. Long-term value is created by actual usage. And this distinction matters because right now, a large portion of XRP's momentum appears connected to expectations surrounding future legislation. But legislation is political, and politics moves slowly. Markets often price in the outcome before the outcome is guaranteed. And this creates risk, because when expectations become too high, disappointment can create violent reversals. But here's where it gets interesting, ladies and gentlemen. The biggest variable facing crypto markets may not even be inside Washington. It may be inside the Federal Reserve. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. See, to understand what happens next, investors need to understand one simple concept. Liquidity controls risk appetite. When interest rates are low and money is abundant, investors tend to search for higher returns. They move into growth stocks. They move into emerging technologies. They move into cryptocurrencies. But when the Federal Reserve raises interest rates, the equation changes. Borrowing becomes more expensive. Capital becomes harder to access. Investors become more selective. And speculative assets often feel the pressure first. This is why the Federal Reserve is arguably the most important institution in global markets. Not because it controls every market, ladies and gentlemen, but because it influences the cost of money itself. Right now, markets are watching increasing odds that the Federal Reserve could raise interest rates again due to renewed inflation concerns. The probability reportedly increased from approximately 50% to 62%. Let that sink in. And the reason is inflation. Consumer prices remain elevated. Energy costs remain a major concern. And geopolitical tensions are adding another layer of uncertainty. Now, this is what most people miss. Crypto investors often focus on crypto-specific events, ETF approvals, regulation, token adoption, partnerships. But crypto does not operate in isolation alone. It exists inside the global financial system. And the global financial system still revolves around central bank liquidity. One of the biggest drivers behind renewed inflation pressure has been energy. Oil prices have remained elevated due to escalating tensions in the Middle East, involving continued conflict involving the United States and Iran. Energy is one of the most important components of inflation. Why? Because energy impacts almost everything on Mother Nature and Earth. Transportation, manufacturing, food production, supply chains. When oil rises, businesses face higher costs. Eventually, some of those costs reach consumers. This creates a difficult situation for central banks. The Federal Reserve wants inflation under control, but geopolitical events can make that much harder. And this creates a dangerous feedback loop. Higher oil prices increase inflation. Higher inflation forces central banks to stay restrictive. Higher rates reduce liquidity. Reduced liquidity pressures risk assets, including crypto. Let that sink in. Now, this does not mean XRP cannot rise. No, markets can move higher even during restrictive environments. But investors need to understand the broader battlefield, because the question is not only does XRP have a long, strong-term case, the question is what environment is XRP operating inside? A great asset in a poor liquidity environment can still experience volatility. History provides an important lesson here, ladies and gentlemen. During the 1970s, the United States experienced a period of severe inflation. Energy shocks played a major role. Oil prices surged. Consumer prices increased. And eventually, the Federal Reserve under Chairman Paul Volcker responded with aggressive interest rate increases. The result was painful. Borrowing costs soared. Economic activity slowed. Markets experienced extreme volatility. But the purpose was to restore confidence in the currency and stabilize inflation expectations. The lesson is not that today is identical to the 1970s. History rarely repeats perfectly, but it does provide patterns. When inflation becomes a persistent, central banks often prioritize price stability over asset markets. And this is the key point. The Federal Reserve does not exist to support cryptocurrency prices. It exists to manage monetary conditions. Investors who ignore that reality are often surprised when liquidity changes direction. Now let's return to the Clarity Act, because regulation still matters. A successful regulatory framework could represent a major step forward for the crypto industry. It could define clearer roles between agencies. It could reduce uncertainty. It could encourage more institutional participation. But passing legislation requires politics, and politics requires votes. The challenge is that the Clarity Act reportedly faces a difficult path requiring significant bipartisan support. Republican lawmakers have generally been more supportive of crypto-friendly legislation. However, many Democratic lawmakers remain more cautious, with some favoring alternative approaches such as government-backed digital currency frameworks. This creates a political divide, and this divide matters because markets often underestimate how complicated legislation can be. Investors may see a headline saying, crypto regulation is advancing, but behind that headline are negotiations, committees, votes, and political incentives. But the real shift came when the global competition around digital assets became impossible to ignore. While the United States debates regulatory frameworks, other countries continue moving forward. Countries including Russia, China, Hong Kong, South Korea, and Japan all have been exploring different approaches toward digital asset integration. The motivations vary. Some want financial innovation, some want improved payment systems, some want greater control over digital infrastructure. But the broader message is clear. The global financial system is changing. Digital assets are becoming part of the conversation around payments, settlements, and financial infrastructure. This is why XRP supporters focus on institutional utility. The argument is not simply about price speculation. The argument is about whether blockchain networks can become part of the future financial system. And that distinction matters because short-term noise, long-term structure. Prices reacting, the system's evolving. However, investors must remain disciplined. A technology can have long-term potential while the asset price experiences short-term pressure. Both things can be true at the same time. So where does this leave XRP, the anointed one? The answer depends on time frame you are analyzing. In the short term, XRP is reacting to expectations. That market is pricing in optimism around regulatory clarity. But expectations can change quickly. If the Clarity Act loses momentum, if inflation accelerates, if the Federal Reserve becomes more aggressive, risk assets could experience pressure. XRP could potentially revisit important support levels as traders reassess expectations. But longer term, the discussion becomes different. The question becomes, can digital assets become a meaningful part of global financial infrastructure? That is the bigger question, because markets often confuse price movement with fundamental change. A falling price does not always mean a broken thesis. A rising price does not always mean success. The most important investors understand the difference between market cycles and structural trends. And that is exactly why XRP finds itself today. A battle between short-term speculation and long-term transformation. See, the biggest mistake investors make during major market transitions is focusing on the most visible story instead of the most important story. Right now, the visible story is the Clarity Act. It is easy to understand, a major piece of crypto legislation, a potentially regulatory breakthrough, a possible catalyst for institutional adoption. But the deeper story is liquidity, because every major financial market eventually answers to one question: how much capital is available and what is the cost of that capital? Crypto investors learned this lesson during previous cycles. When central banks expanded liquidity risk, assets benefited. When central banks tightened liquidity, speculation became much harder. And this is why the Federal Reserve remains such an important variable. The Fed does not need to directly mention XRP. It does not need to mention Bitcoin. It simply changes the financial environment, and markets respond. But here's where it gets interesting. A market can be fundamentally correct in the long term while still experiencing major volatility in the short term. This is the difference between understanding the technology and understanding the cycle. One of the clearest examples of this distinction came during the dot-com era. In the late 1990s, investors correctly identified a revolutionary technology. The internet was real. Digital transformation was real. Companies that embraced online infrastructure would eventually reshape the global economy. The long-term thesis was correct, but the market cycle became disconnected from reality. Investors began pricing perfection to companies before those companies had proven business models. Then monetary conditions changed. Interest rates increased. Liquidity became tighter. Investors' psychology shifted. The result was a major market correction. Thousands of companies disappeared, but the internet itself did not disappear. In fact, the companies that survived became some of the most powerful businesses in the world. The lesson is extremely important for crypto investors. A transformative technology can survive a market downturn. A strong long-term thesis does not eliminate short-term volatility. This is why investors must separate the asset, the technology, and the market cycle, because they are three different things. Now we return to XRP, the anointed. The debate around XRP often becomes emotional. Some investors only focus on price targets. Others dismiss the entire sector as speculation, but the reality is more complicated. The long-term argument around XRP is based on infrastructure. The idea is that blockchain technology can improve areas like cross-border payments, settlement efficiency, tokenized assets, institutional liquidity. The financial system is becoming increasingly digital. Banks, asset managers, and governments are exploring how traditional assets can exist in digital environments. This does not mean every blockchain project succeeds. It does not mean every token captures value, but it does mean the underlying transition is real. The financial system of the future will look differently from financial systems of the past. And this is why institutional investors are paying close attention. Not because of hype, because infrastructure matters. Now, this is what most people miss. The biggest opportunities in financial markets are usually created during periods of uncertainty. When an industry is transitioning from one system to another, there's always confusion. There is always skepticism. There is always volatility. But that transition is when new winners emerge. A useful analogy came from the railroad expansion of the 19th century. Railroads completely changed the global economy. They connected cities. They transformed trade. They accelerated industrial growth. But during the railroad boom, many investors made mistakes. They invested in companies without understanding which businesses would actually survive. The technology was revolutionary, but not every company built around that technology became valuable. The same concept applies today. Blockchain technology may become a major part of global finance, but investors must still analyze which networks create real utility, which have adoption, which solve meaningful problems. Technology alone is not enough. Execution matters. Network effects matter. Institutional acceptance matters. The digital future will matter, but the winners will still need sustainable economic models. Now let's return to the Federal Reserve, because this is where many investors underestimate risk. If inflation continues to surprise higher, the Fed may have less flexibility. Higher rates for longer could create pressure across markets, stocks, real estate, growth companies, cryptocurrencies. The reason is simple. Higher rates increase the return investors can receive from safer assets. When government bonds offer attractive yields, investors become less willing to chase speculative opportunities. This does not mean crypto disappears. It means the environment becomes more selective. Strong projects with real adoption may separate themselves from purely speculative assets. This is a natural process in every financial system and cycle. During easy money periods, almost everything rises. During restrictive periods, investors demand proof. They ask, what is real? What is sustainable? What has long-term value? And this environment could ultimately benefit projects focused on actual utility. Another analogy comes from the transition from horses to automobiles. When automobiles first appeared, many people questioned whether they would replace existing transportation systems. Many early automobile companies failed. The industry experienced chaos, but eventually the technology transformed society. The important shift was not one company. It was the infrastructure change, roads, manufacturing, supply chains, energy systems. Entire industries evolved around the new technology. Digital assets may represent a similar infrastructure transition. The question is not simply, will one token go higher? The bigger question is, what financial systems are being built for the next generation? Because price is reacting, the system's evolving. So how should investors think about XRP and crypto markets in this environment? First, do not ignore macro conditions. Write this down. The Federal Reserve matters. Interest rates matters. Liquidity matters. Second, separate headlines from reality. A legislative headline can create excitement, but actual adoption takes time. Third, understand time horizons. This is the most important as far as I'm concerned. A trader and a long-term investor may look at the exact same asset and reach completely different conclusions. A trader may focus on support levels, momentum, and catalysts. A long-term investor may focus on adoption, infrastructure, and market position. Both perspectives can be valid. The mistake is confusing them. The biggest opportunities often require patience, but patience does not mean ignoring risk. Ladies and gentlemen, the future of XRP will not be determined by one headline, not by one vote, not one Federal Reserve meeting, not one price movement. The real story is much bigger. It's about the collision between traditional finance, digital infrastructure, central bank policy, government regulation, and global competition. The Clarity Act could become an important milestone, but investors should remember regulation creates opportunity, liquidity creates market conditions, and both matter. The smartest investors are not choosing between the macro story and the crypto story. They are understanding how they interact, ladies and gentlemen, because short-term noise can distract from long-term structure. XRP's future depends on adoption, but XRP's price in the near term depends heavily on the financial environment surrounding it, and the environment is being shaped by the Federal Reserve. Ladies and gentlemen, if you found this analysis valuable, make sure you subscribe to the channel because we are continuing to track the biggest shifts happening across crypto, macroeconomics, and global financial infrastructure. The next few months could become one of the most important periods for digital assets, not because of speculation, but because the financial system itself is changing. The question is not whether the change is coming. The question is who is prepared when it arrives. Thank you for watching, and I'll see you in the next analysis. Hope everyone's having a blessed afternoon. I want to welcome all the new members of the Patreon, all the new members of the membership channel. Ladies and gentlemen, with the story now changing back in the limelight about oil could reach 120 if certain conditions match. With the Houthis entering the conflict, talking about a naval blockade of one part in the Red Sea, that could put a lot of pressure on it. Time of this recording, oil's around $85 to $86. Nothing in this video is financial advice, just my opinion or retains any capacity. I want to point something out. I always talk about the Harry Houdini freak show of themes. If you look where gold and silver are, they're moving higher. To me, everything is moving higher now because the views on interest rates are changing. That is to be paid attention to. If by quarter four things stay as big turbo as they are, and if oil continues to march higher, there's going to be a lot of trading activity that's going to influence a lot of markets. Ladies and gentlemen, if you want to learn how to trade, if you want to learn how to invest, come and join the Crypto Public Desk monthly and join over 600 active traders. One solid tip in the pits can pay for your entire year. Subscribers who joined during the last I would say not during the first episode of the Harry Genie Freak Show, when the first Middle East conflict was firing, because we look at this as the second Middle East conflict now, the second part of the movie. Subscribers who were in saw returns that were astronomical from the Tips and the Pits calls. So if you want to experience these gains in stocks, futures, cryptocurrencies, come and join the Crypto Public Desk Monthly, because the gains are going to be better this time around, because the board is a lot clearer as far as we're concerned, because things are being taken off the table. Not financial advice, just my own opinion, entertainment, any capacity. The Crypto Public Desk Monthly. Also inside, we have created a new tier of straight podcasts where you will hear straight rants that I have about a lot of things. Domenico, the surgeon, his rants about a lot of things. And videos on ICP, XRP, XLM, HBAR, and a lot of other things going on. So do come and check that all out. But if you see what's happening right now and how you don't get caught up like sushi right now, because if you think in the last week, market's completely reversed, right? You have to take this view and this viewpoint right here to not get caught up like sushi. Death by 1,000 tweets, death by 1,000 headlines. So as gold is approaching higher, silver is approaching higher, understand that there's investments and there's trades. When there is a normal theme in the market, we can trade everything and it's good to go. Oil, silver, copper, gold, platinum, palladium. It's there. But don't lose your conviction about why you're in this market, because things change. When people watch Netflix, you think anybody cares about the technology behind it? When you go shopping on Amazon, do you care about the technology behind it? One day, people are going to think about cryptocurrencies and blockchain, and it'll be the same thing. But right now, there's a lot of chaos in the markets. As financial mercenaries, we focus on something to be correct with our assumption, our recce, our trading plan. Right now, it's being driven by chaos. At some point, it will just be interest rate story. We got the interest rate story, and we got chaos. Clarity is going to get voted on. We're in the camp that it gets passed. Once that is done, it's going to be left to these two themes. Eventually, the market will get used to certain things and move higher. We have our own convictions of where things are going. This is not financial advice and retains any capacity. But understand this, ladies and gentlemen. We believe the window for accumulation is closing. Closing for many things. And you have to keep the Gucci conviction, the Gucci clarity. Understand why you started this in the first place. In the comments, tell me why you started this in the first place. I'd like to know. But don't get shaken out here right now. Don't FUD, don't FOMO, nothing, because this frosty march up this frosty mountain, drinking our frosty beverage, has only begun. But at the end of the day, ladies and gentlemen, we are in the right place at the right time. You have to control your conviction in your mind, because position signs matter. The future is coming. You can't stop that. I love you all, ladies and gentlemen. I'll see you on the front lines. Do come and check out the Crypto Public Desk Monthly. We're going to have a lot of member-only videos, ICP, XRP, HBAR, XLM, and a lot of other things, and just straight rants at some point that we just can't do here because of compliance reasons. None of this is financial advice, just my own opinion and retains any capacity. Never invest based on watching a YouTube video. This video is always just for educational entertainment purposes only, not financial advice. Never, ever invest money based on watching a YouTube video. Consult your licensed financial advisor always. But here's my final tip from Daily Financial Combat. While the diversion of financial chaos is here, take advantage of it if it makes sense to your own situation. If you're DCAing and it makes sense to your own personal situation, you're doing well. Don't over leverage yourself. Remember what Jesse Livermore said. Your position size has to be small enough to be added to, cut, carried. This is a occupation. It's a profession. This is not you wager more, you get rich tomorrow. The law of the market will destroy you. As financial mercenaries, we fight this financial battle every day. When we're given themes that produce outcomes, our life is a lot easier. If you want to see how these themes can turn profitable trades, come and join the Crypto Public Desk Monthly. One solid tip pays for your entire year. You want to learn to trade, invest, come and join over 600 active traders, investors. I love you all. I'll see you on the front lines. Have a blessed evening.